Hi, I'm Mark Simpson, author of Excellent Investing, How to Build a Winning Portfolio. And given that none of us will be attending many investor events over the next few weeks, I thought I'd bring the investor event to you and give a talk online about some of the topics from my book. If your portfolio is anything like mine, then over the last few weeks, then you will have faced some losing investments. And how we respond to those losing investments is a key part of our investment strategies. So this talk I've called, is it better to average down or to cut your losses? And I think is particularly relevant for these times. Now, this is a controversial topic. Many people have opposing strong views on this subject. And this isn't helped by lots of professional investors disagreeing about the right strategy for this as well. For example, Walter Schloss, who worked for Ben Graham and is set up his own successful value investing fund, says, I must say, I never have put in a stop loss order, because if you like a stock and buy it and it goes down, then you should buy more if you can afford it. In contrast, though, Paul Tudor Jones famously had this sign on his wall above his trading desk saying, "Losers average losers." So which is it? Should we be buying more like Walter Schloss, or is Walter Schloss a loser for doing that? But before we go into which strategy works best and in what circumstances, then I want to look a little bit at why losing investments cause us so many problems. And this is because of a behavioral bias that we all have, and it's called loss aversion. And loss aversion means we hate taking losses far more than we enjoy the equivalent gain. So that we dislike taking losses is hardly surprising, but the magnitude of our dislike is the thing that's different here, and is significantly more than the enjoyment we get from gaining the same amount of money. I want to look a little bit at loss aversion in action. So I've got a couple of example scenarios here that I'd like you to think through. So the first is a choice here. Would you choose to receive a certain £100, or would you choose to flip a coin and have a 50-50 chance of winning £200, but with a 50-50 chance of getting nothing? So hopefully have a think about that scenario, think which you would prefer. And then I'm going to give you a second scenario. So in this scenario, I now give you £200. So imagine me taking the money, maybe 10, £20 notes, counting them out, putting them into your hand. That's your money that you now have. But you have to make a choice. You either have to give back a certain £100, or again, we can flip the coin, and if it lands heads, you get to keep the full 200, or if it lands tails, you have to give back the full £200. So again, think about this scenario and think which way you would choose. If you're like anybody else, or the vast majority of people, then in the first scenario, you would have picked A. You would have preferred the certain £100. And I think I would have taken that choice too. But interestingly, if you were also like the majority of people, in the second scenario, you would have preferred to gamble and you would have tossed the coin. That doesn't seem strange, apart from when you consider in detail that both scenarios are identical. You either come away with a certain £100 or you have a 50-50 chance of winning, coming away with £200 or zero. However, in one case you preferred, or if you were with the majority, you preferred the certainty, and in the other case you preferred the gamble. And why is that? Well, this is what loss aversion does to you. Loss aversion means you try to avoid taking losses. So when something's described as gains, we prefer the definite gain to the risky bet. But when all the options are bad and the only option is to take a loss, we roll the dice, or toss a coin in this case, and hope that we'll avoid taking the actual loss. Loss aversion is also why we feel happier about a high win ratio rather than overall portfolio gain. If you had 10 stocks and 9 went to zero, but 1 did 20x, then you've doubled your money. Most people, though, would be unhappy with this return because they would focus on the fact that they lost 9 times out of 10 rather than that they overall doubled their money. Loss aversion doesn't just affect our financial decisions either. Let me tell you about a story about loss aversion and about a chap, let's call him William, and his wife. So William and his wife are looking to invest for their daughter's education, specifically for university many years in the future. And they're looking around. They're not particularly wealthy. William is a local politician, but they have a bit of money to put aside, and they choose to go into business with a real estate developer. A friend has a real estate project, and he offers them the chance to buy into this real estate project. Now, unfortunately, after a bit of time elapses, the real estate project isn't doing particularly well. They aren't getting planning permission they expected, and the investment is burning money. But not all is lost. The friend offers William a chance that he can buy out of, or he can cash out of the investment. He'll only lose 20 cents of the dollar, so he'll come away with 80% of his investment intact, and maybe he can find something that's more suitable for his investment needs. But being loss averse, William isn't willing to take the loss. He rolls the dice and he hopes that the investment will come good. Now, this happens several more times over the years. Each time he's offered a slightly less amount of money to get out of the investment, but each time, despite no real chance that this investment is going to pay off, loss aversion keeps him in the investment. In fact, his wife says, "I still believe this investment will put our daughter through college." Now, in the meantime, William managed to get himself elected to a high office in his country, which means he should really be focusing exclusively on the affairs of state. However, he cares so much about this small property deal gone bad that he gets one of his aides to try to micromanage the property deal. Tragically, in strange circumstances, the aide ends up committing suicide, and that starts to lead people to investigate, well, what exactly was he doing for William? When they find that instead of doing his job, he was spending a lot of time on this small real estate deal, then people are not particularly happy with how William has behaved. But they offer him two options. The first is called a censure, so it's like a sort of slap on the wrists. The second is to agree to a wide-ranging investigation into all of his affairs. Now, being loss averse, William will not take the definite loss of a censure, and instead rolls the dice, hopes there's no more things to find, and agrees to the wide-ranging investigation into his affairs. During this investigation, unfortunately, though, they find that he's having a sexual affair. At this point, he has two options. He can go on TV, he can apologise to his wife, his constituents and his family and say, it was a mistake, it won't happen again. But that is a definite loss. And being loss averse, William rolls the dice and he hopes that they don't have any real evidence of the affair. He went on TV and said, "I did not have sexual relations with that woman." And of course, they did have the evidence, and William Bill Clinton was almost impeached by Congress, not for the affair, but because he tried to lie about it. His concept was less than exemplary in a number of ways through this affair, but it was the loss aversion that came the closest to being his downfall. And if successful politicians and presidents suffer from loss aversion, it's quite likely that both you and I do too. So, away from politics and back into investing, I wanted to have a look at what loss aversion typically looks like in somebody's portfolio. And the classic sign that somebody is suffering from loss aversion is a long tail of very small losing positions. So you might see 0.1, 0.2, 0.3% of somebody's portfolio in a number of stocks. Of course, this doesn't really make sense, unless these are option-like strategies, then they're too small to have any real impact on the future performance of this portfolio. So why do a lot of people have this long tail? Well, when you look into it, they're often the losers. They're the ones that started off as a larger position, have become smaller and smaller, and somebody just isn't willing to sell. They're hoping and they're gambling that a recovery will come at some point. And unfortunately, it rarely does. And even if it did, once you're down to 0.1, 0.2% of a portfolio, then it's not going to make any difference if it does. So what can you do about it? Well, I think it's important to set a minimum holding size in your portfolio. And this is something I do. You take a scalpel to the smallest positions and you say that if a position drops below a set percentage of my portfolio, let's say the 1% I've used in the example here, and this is the key, I'm not willing to add to the position now. If I have the money, then I sell it. If I'm not willing to add, it's a sign that it isn't really my best idea. It isn't something that I think truly has a great future or a great return in the future. So therefore, I just get rid of it. I sell those positions. What else can we do? Well, if we understand that loss aversion is so pervasive and such a powerful effect, maybe we should always have a stop loss. And this is one option for a number of investors, but it's not always ideal for a number of reasons. The first is, well, the level of the stop of any stop loss is arbitrary. You put it in position to your buy price with maybe some value lower than that price, but that has no fundamental valuation attached to it. It's merely a arbitrary value from an arbitrary point of view. The other issue is that you can get stopped out by noise. So that is, most people apply a stop loss so that they want to force themselves to sell when there is a fundamental negative change in value. However, they don't want to sell just because market noise has made the stock go down. But particularly at this time, I think people have seen the big moves in stocks, and also that stops can be hit by other investors. So either intentionally or unintentionally, I think we've seen cases recently where somebody's stop has been hit, which has caused the stock to sell into a low liquidity environment, caused a large drop in the price, which has caused other people's stop losses to be triggered, which has caused a large drop in price, and the cycle has continued. And in some cases, stocks have dropped much lower than the true fundamental value that may be of that company. So what does the data say we should do? Well, for this, I'm turning to a book called The Art of Execution by fund manager Lee Freeman Shaw. Freeman Shaw was a fund of fund managers, so he allocated capital to other managers to manage on his behalf. And he analysed about 31,000 trades of the almost 300 managers that he allocated capital to. And he wanted to know what drove investment success. And he found that how they reacted to losing investments was actually one of the key criteria. And to make it memorable, he separated investors into 3 categories. He called them assassins, hunters, and rabbits. And we're going to have a little look at what those types of investors are. So first up, assassins. Assassins always sold positions as they had declined, usually when they were about 10 or 20% down. And assassins turned out to be winning investors. And they were particularly good if they could hold on to their winners. So they didn't suffer from the other dimension of loss aversion, which is the desire to take the certain thing to sell the stock that is showing you a profit rather than the stock that's showing you a loss. Diametrically opposite to assassins were the hunters. So hunters bought more as the price declined. So these are your average downers. And interestingly, they were also winning types of investors. They made money often even when the stock never rose above the initial buy price. It was their ability to reduce their average buy price by averaging down that meant that they eventually made a profit as the stock rose. In contrast were the rabbits, and these were losing investors. They froze in the lights and they did nothing. They didn't react at all to the declining stocks. And what happened was they were run over by the market. So at the end of the day, it doesn't really matter if you are a hunter like Walter Schloss or you're an assassin like Paul Tudor Jones. It's important that you find a strategy that fits your personal style of investing and you're consistent and you stick to it. And you don't be a rabbit and and always have a plan to react proactively to falls. Now at this point you might already know what type of investor you should be, whether you should be an assassin or a hunter. We often have strong attachments to one way of operating or the other. But if you're not sure yet, if you don't know, I think usually value and quality investors, so value investors are those who look for the unloved stocks that are cheap on a number of metrics. Quality investors are looking for sometimes high returns of capital, strong competitive advantages and long runways for that capital to be reinvested into. They often make better average downers. They make better hunters. However, conversely, momentum, so those who are following mainly price action or price and fundamental action and don't care so much about the value they're getting, or growth investors who are looking again for very rapidly growing companies, they tend to be better off being assassins and cutting their losses. Now, even when you know which type of investor you should be, a hunter or an assassin, there are still mistakes you can make, and there are ways you can improve the execution of your chosen style, and I want to go through a few of these today. So let's look at hunters first. So I want to give examples of when hunters shouldn't hunt, when they shouldn't average down. So the first, I think, is quite common, is if it makes the position size too large. So not having all your eggs in one basket kind of makes sense. There's no matter how well you know a stock, there is always an event that can cause a total loss of any individual stock, and it usually comes out of left field. It's usually the things you haven't considered that cause the big problems. And to protect against that, having an upper portfolio limit and not having too much money in one stock is a good thing. So you shouldn't average down if it makes the position size too big in your portfolio. But even if you have that portfolio limit, you can still lose a lot of money averaging down. So for an example, say you put 10% of your portfolio in one stock and it halved, and then you added another 5% to bring it back up to the 10% weight, and then it halved again and you added another 5%, suddenly you've put 20% of your available portfolio into that stock. So if that goes to zero, then you've effectively lost 20% of your money, even though you never went above 10% at any one time. So the key here is to have what I call an at cost portfolio limit. So you've got 10%. If 10% is the ideal position size, you've got 10% to allocate in total. How you do that, whether it's 5% first and then a couple of percent each time the stock goes down, would work, but you make sure you never put more than 10% of your portfolio at cost into one stock. And if you think this is this is quite basic and you would never fall for this error, so some very well-known funds, some very good funds have fallen for this error. Take, for example, Sequoia. So this was started by Bill Rowan in 1970 and was actually where Warren Buffett recommended the investors of his original Buffett partnership put their money in when he closed the partnership. Despite having a 45-year track record, this didn't stop Sequoia losing a lot of money by averaging down in Valiant stock. So at its peak, Sequoia had over 30% of the fund in Valiant. And when it had 30% in, the stock halved. So they'd already lost 15% of their portfolio on that one stock. Yet at that point, I think by this point Rowan had died, so he'd handed the fund on to his partners. But the partners chose to invest even more money into Valiant after it had halved. But this didn't stop the share price falling. And eventually, when Sequoia gave up, they sold their Valiant stake when it was 90% down from the peak. So they'd lost probably over 30% of their fund by value in this one stock. Something that I think most of us would be keen to avoid. I know I certainly am. So other times that I don't think, or you should be a sleeping tiger and you shouldn't hunt. The next is highly leveraged stocks. Consider the cautionary tale of Bill Miller. So Bill Miller was once considered one of the greatest value investors. He beat the S&P 500 after costs for 15 years straight. So when people did academic studies, is successful investing chance or is it luck? They always used Bill Miller as the example of skill. However, after those 15 years, in 2006 and 2007, he lost all of his previous cumulative outperformance of the previous 15 years. Think about that. He lost all the previous cumulative outperformance of 15 years in just 2 years. And that was by averaging down on the likes of AIG, Bear Stearns, and Washington Mutual. Highly leveraged stocks. And if you think about it, they were also, well, apart from Bear Stearns that did go to zero, they were the sort of stocks that were bailed out by the government. So if there hadn't been a government bailout, he would have done even worse than that with his averaging down. The final one is companies that risk of technical obsolescence. So for example, Kodak. Companies that are in declining markets can sometimes make good investments. The lack of competitors means they sometimes have quite high returns on capital, and they often have high cash flow they can return to investors. But there's still a pretty high chance that eventually they go to zero, and therefore it's not the sort of stocks that you want to be averaging down on. So those are the common errors that hunters make, and when I think you should be a sleeping tiger. Let's look at the assassins next. So how do you become a better assassin and improve your stop losses? Well, the first is, I think you should consider using trailing stops. So trailing stops are where you increase the value of your stop as the share price increases. This is particularly useful for momentum investors, so those who follow price trends, because it means that you capture almost all of the upside. So while you have momentum on your side, you stay in the stock. However, when that momentum fades and it starts to go down, your trailing stop loss brings you out of the stock fairly rapidly. And you capture the majority of the positive move in the stock. You should also probably account for the spread and the volatility when choosing where to place your stop. So rather than saying, oh, I always place it at 20% below my buy price, then you could look for very volatile stocks where you place your stop much lower, say 30%. And for less volatile stocks, then you place it at maybe 10%. That means that your stop takes you out of the stock when the fundamental value of the stock changes, but not when simple noise, the movement of the market, brings the stock price down temporarily before going back up again. Finally, some people search for stops, so they know that investors place stops at round numbers, and they will, in illiquid times, they will move the market to cause those stops to be triggered. So the other one is to not place your stops at round numbers or the kind of more obvious levels that other people will use stops at. So the £1 level, for example, where a lot of people would pick a round number for their stops. So that brings it to the end of this topic. In summary, everyone is loss averse. So to become a successful investor, you must have a strategy to overcome this loss aversion in your portfolio. I think it makes sense for everybody to have a minimum holding size. Value and quality investors are often better off being the hunter, and momentum and growth investors are often better off being assassins and using stop losses. But whichever you are, the key is don't be the rabbit and don't get run over by the market. Right, thank you very much for joining me and getting this far. I hope you found that both interesting and entertaining. If you did, please buy my book. It's available on Amazon, so if you put in excellent investing into Amazon, then it'll come up. There's also some good reviews on there, so if you want to check that out, then that would be great as well. And finally, I'll leave you with a link to my website where there's some other book recommendations that you might want to look through. And also, if you've got any questions about this or comments or feedback, then I'll put my email address up there as well. So thank you very much for joining, and hopefully we'll have another video for you sometime soon. Thanks, bye.